Welcome everyone to our call, our monthly call. Never a dull moment. So we've got two big questions here. Is the 40-year bull bond market at risk? And is the equity bull market at risk? So let's start with interest rates. That seems to be the cause of concern, the rapid rise in the long-term treasury bond yield from 1 to 1.6. Much faster, I think, than anyone, whether technicians or economists, expected, especially given the Fed's stated support for lower interest rates. And so this was a bit of a shock to the system. When we're thinking about interest rates and bond markets in particular, we think about what they might be incorporating. Is inflation going to be a problem? I think is the topic at hand. Now, we do know that in the next few months, because prices last year were falling in the coronavirus crisis, they were in decline, that there is something called the base effect we will be dealing with, and CPI-based inflation could approach 4%. Now, we know that energy prices in the futures market went negative last year, which is pretty astonishing. And today we're in the 60s. So that gives you a sense, that's of course a spot market number, that gives you a sense of the drama here. We believe that the inflation will dissipate. The Fed believes that as well. And in fact, the Fed is saying that it doesn't mind if inflation breaches 2% and stays above 2% for a while. I don't think they would like 4%. And I think as economists were doing the arithmetic and the idea of a 4% year-over-year number started to enter conversations, I think there was a bit of a reaction in the bond market. The question for bonds are long-term instruments, is not what's going to happen this month or next month. And the base effect could take through May. It is what is the long-term outlook for inflation. And in our view, there are deflationary forces accumulating here, both good deflation and bad deflation. Forgive me if some of you have heard this before. We're talking about it now because this topic is so important and the concern is so great. So the good deflation, as those of you who have been listening to this call for some time know, is the deflation associated with innovation. And there is a lot of drama here as well. It's what we center our research around, Wright's Law. For every cumulative doubling in the number of units produced, how much do costs decline? Costs decline at a consistent percentage rate, depending on the technology. So in the case of electric vehicles, the prime mover there is going to be the battery pack system, or the battery, as it is being built into the infrastructure of the car. And the answer in terms of the deflationary undercurrent there is for every cumulative doubling in the number of electric vehicles produced, costs will decline at a 28% rate for the battery. That is, when you think of EVs going from 2.2 million in sales last year to 4.4, we think that's not going to take very long. And with that will be a 28% decline in the cost of the biggest component of the electric vehicle. And that is why we see auto prices deflating during the next few years on balance. The electric vehicle, from our point of view, is going to drop to, on average, $18,000 in 2025, compared to the Toyota Camry at that time, which will still be in the $25,000, $26,000 range. So that gives you a sense of the good deflation. The demand for electric vehicles is going to explode. That will show up in unit growth. However, also showing up in unit growth will be the decline in gas-powered vehicles. So it's going to be very confusing, I think, during the next few years for all sorts of reasons, but primarily this good deflation, bad deflation. The bad deflation, we think auto companies are going to face it, and many other companies. And it has to do with companies who did not invest enough in innovation. I think the surprise for us over the years has been how long it took traditional auto manufacturers to invest aggressively in electric vehicles. It's only been the last 2 years. We were beating the drum when we first started the firm. And at that time, most auto consultants and auto manufacturers and analysts believed that electric wouldn't be relevant to them until the mid 2020s, more than a decade later. That was wrong. And we think it's going to be wrong for a lot of other industries as well. Innovation is happening much faster than they expected. So what is bad deflation? Bad deflation is these companies who didn't invest enough to embrace innovation and or at least soon enough, and spent the last 10 years catering to shareholders who wanted profits now. They didn't want companies to sacrifice short-term profitability in order to invest, by and large. They wanted profits now and to keep their valuations in line. So they had a very short-term time horizon, very risk averse, I would say that was. And they did something beyond that, which I think will look unconscionable when viewed through the lens of history. They leveraged up to buy back shares and to satisfy the short-term profit expectations and demands of shareholders. I think that's going to come back to bite them because now they have to service that debt. And they have to invest aggressively as their base businesses are deteriorating. So in order to attract demand to, let's just use autos here again, to the gas-powered autos as electric vehicles drop in price below those for gas-powered vehicles, they're going to have to cut prices and in order to service cash flow. And I don't mean to pick on the auto industry. We just see the electric movement moving so much more quickly than anyone expected. And now it's being turbocharged by China. And so this good deflation, bad deflation, these two forces are, of course, going to fight what the fear is of many investors right now, and that is inflation. We learned a lot in 08-09 or in the aftermath of 08-09 about monetary policy ease and dramatic ease and the impact on inflation it was going to have. I was wrong. I thought we were going to be facing an inflationary environment. And the reason I was wrong was the velocity of money continued to fall. Now, what that means is people started to save more, and they weren't buying goods and services more and more rapidly because they were fearful prices and interest rates were going up. No, the opposite. They were still struck with fear of a sort. After 08-09, we almost had a financial meltdown then. I think we've had the coronavirus. That has caused another discrete move down in velocity, and saving rates are huge. Now, will velocity continue to fall? I do think the fears out there are such that it wouldn't surprise me. But if we are right and deflation becomes the bigger topic, that will actually encourage a continued decline in velocity. Why? Because if you know that goods and services are going to be cheaper, less expensive a year from now or a few months from now, you will defer your purchases. It's the opposite of an inflationary environment. And I think this could be the biggest head fake out there. So do we think the 40-year bond bull market is at risk? In a sense, no. I wouldn't be surprised to see us get back to 3% on the long-term Treasury yield, which is a doubling from here after the recent tripling from 50 basis points in the depths of the coronavirus. So still some more drama probably in bonds, and these are the risk-free instruments like government bonds. But there's another consideration here for the bonds. Right now, bond spreads. So the difference between corporate bond yields and high or junk bond yields and treasuries is quite low by historical standards. I mean, very low. What that means, it seems, is that bond holders, corporate bond holders, are satisfied that the Fed will continue to support a lower interest rate environment, and that the economy is going to remain very strong. So what if that changes? We don't think it's going to change because of the economy. The economy, we do believe, is going to be strong. But as more and more industries succumb to innovation, you know, we do have a poster child for this. It's the retail industry. So the more that investors believe that innovation is here and the traditional world is in harm's way, I think corporate bond yields are going to have more problems. So it depends. If you're involved mostly with government bonds in the United States, you're probably fine. You'll suffer a little bit more. But I think that the underlying deflationary forces out there will support those bonds. The underlying deflationary forces, however, will not support all corporate bonds. In fact, it will probably destroy some of them. So we'd be careful in answering that question. The easy money days are over in bonds, we believe. That, yes. In terms of a move back into 8, 9, 10% interest rates, which would be truly destructive for all bonds. No, we don't think that's going to happen. We do think, once again, that corporate bonds, you really have to be very careful in investing these days. And I would say that the private equity world has been one of the biggest culprits. Watching what they do to companies just to get distributions, how they've leveraged up some of these companies. I mean, those are the ones we really have to watch. So again, a little bit of a mixed answer there, but wanted to present those differing points of views. As far as the equity bull market, well, if what we're saying is correct about bonds, you will see the impact in equities, but there will be a bifurcation. Those companies in harm's way, the way I just described, are going to probably have a very, very tough time. And their equities will not do well. Those companies embracing innovation, even if they're from the old world, they're just moving in aggressively, spending aggressively in these new technologies. They'll probably be fine. They won't be the best stocks out there because they won't be pure play innovation, but they'll probably be fine. I would liken what's going to happen to what has happened in retail. You've got the Walmart, Costco, Targets, and it seems like a lot of other companies that have been in harm's way are suffering, and the stockholders with them. As far as the equity market, I'd like to tackle it now from a couple of other points of view. We know that profits drive the markets, and we do believe we're in a V-shaped recovery, very strong cycle, and the two sectors that are leading the way have the highest multipliers, so housing and capital spending. So the V-shape is continuing, and now we're going to have leisure and hospitality joining the party again, so to speak. So I think we're on our way. What has just happened in the equity markets is a massive and severe, I guess from our point of view, severe rotation into value stocks. This started in the fourth quarter, but it was a mild rotation. And we were surprised at how well, innovation-based strategies performed during that period. Well, the rotation just took off in the last few weeks with interest rates. So I think while many were worried about interest rates and the equity market did go down, what happened was something very healthy. The bull market broadened out into value in a more serious way. This is something I had expected soon after the coronavirus fears started diminishing, and I've been surprised at how long it took to happen. This reminds me of 2016, when President Trump won the election against expectations. The market incorporated immediately lower tax rates and cyclical friendly policies. So value took off, and growth generally, and certainly innovation focused growth, sold off, actually declined as the market was taking off. Feels a little bit like that now. And I gave the answer to this question, is the equity bull market at risk? Back then I said, no, if anything, the bull market has just broadened out. It is becoming stronger. So that's good news. If interest rates are a concern. However, when I think about, and that's valuations, of course, when I think about interest rates, I don't believe the market ever priced in 1%, 1.5%, 2% long-term treasury yields. And the way we know this is, and it did strike me, I was puzzling over it for many years, that every time the S&P 500's PE ratio moved into the 20 to 25 times range, the market sold off. It had become too stretched according to most investors. That suggests that investors were thinking about normalized interest rates. They never gave the market credit for the interest rates as they were falling towards 0.5%. The assumption was, no, we have to base our valuations on normalized interest rates. And it looks like that's probably in the 4 to 5% range, which was the range for GDP growth for many years, nominal GDP growth. We think there has been a structural shift down in nominal GDP growth for two reasons. One, the innovation that we analyze all day long, it is growing very rapidly, 30, 40, 50, electric vehicles, 80% annualized rates, but their bases are too small to move the needle on GDP. Meanwhile, they're starting to disintermediate and disrupt the traditional world order. And as I just described, we're probably going to see consolidation and difficulties in wide swaths of the economy. So we would not be surprised if the true normalized interest rate is closer to 3. So if 4 to 5% normalized is associated with 20 to 25 times as a PE ratio, 3% would be associated with 33 times. So a lot of investors are wondering, how high is high in terms of valuations? We may have gotten a glimpse of what is about to happen to the market as innovation was rewarded handsomely with valuations that even we, watching some of these IPOs and SPACs come out, even we think are way ahead of themselves. But maybe this is a clue that real growth, true underlying growth, is that scarce, and there should be a reward for it. We're not betting on that. The valuations we use 5 years out are more in line with today's valuations as we are setting our price target. So we're not betting on it. We're just saying, I wonder. We have Nick Grous with us today, who will share with us some of what's happening in the media world and giving us a dichotomy, much like I'm describing today, which will be influencing both the bond and the stock market. So Nick?
Thanks, Cathie. And yeah, as you alluded to, I really wanted to talk about what we are seeing in the linear and connected TV space. We've just put a blog out about this shift that we believe is happening from linear to connected TV, but I want to share just a few thoughts and some of the kind of the highlights of that blog. So over the past year, consumers were forced to spend more time than ever before in front of their screens. And we think this woke many of them up to the idea that streaming services across the board and as a group now have more to offer than linear TV. And this shift was happening before the pandemic, but we believe the pandemic really accelerated this shift from linear to connected, or the streaming names. And likely what we're going to see is accelerated cord cutting. We believe that this year we saw double-digit cord cutting numbers, and that by 2025, the number of US linear TV households will be cut in nearly half, from roughly 86 million, and that's at the start of 2020, to 44 million, which is a level not last seen since almost 30 years ago. So you're going back in time in terms of the linear TV landscape and the number of households that are paying for those services. Making matters even worse here, one, you have users dropping off, but what typically follows when users drop off is all of the revenue associated with that business, and especially what we believe will be a waterfall moment in advertising TV spend for linear TV. We believe that all of this advertising is going to shift over to more efficient digital platforms, some of it being in connected TV, actually most of it going to connected TV services, and also just the broader digital advertising ecosystem. And just taking a step back just to kind of paint this picture. So really up until 2020, and despite 8 consecutive years of declining viewership, linear TV ad spend had remained pretty stable. However, with just the acceleration of cord cutting this year and for the next few years, we believe that this advertising shift is likely to drop the number of advertising spend from 70 billion to roughly 34 billion by 2025. So over a 50% decrease in the amount of dollars spent on linear TV advertising. And we've actually seen this story play out before. We've talked about this in the past, but during the global financial crisis of 08-09, after holding strong years, or after seeing declining readership for years, print advertising endured years of double-digit declines after the shock of 08-09. And what happened was it really took this crisis-like moment to shift advertising spend to more efficient platforms. In 08-09, the beneficiaries there were actually linear TV and digital advertising, but what we think has happened after this past crisis in the pandemic is that linear TV advertising is going to have, again, this floor dropout moment, this waterfall moment in terms of advertising dollars, now shifting to more efficient digital platforms. The other thing that we're watching here, and Ren, if you could go to the next slide, is, and we think this is something to constantly be monitoring because of how important live sports are for the live and linear TV market. And what we've noticed, and we've kind of reading the tea leaves here, that for the first time ever, what we're witnessing is you now have streaming players with deeper pockets and more distribution than those players in the linear TV space. What do I mean by that? A company like Roku, who just reported numbers, talked about how the number of households that the Roku TV operating system is now twice that of the linear TV space. If you think about the reach of Apple, Google, and Amazon, they reach more consumers than any linear TV player that's still available today. So we think with the reach that they have and with the deep pockets that they have, we could see one of these major sports leagues in the next few years make a massive shift, which would really shake things up for the linear TV space and add a ton of value to connected TV. Just ending here, we've talked about all this doom and gloom for the linear TV space. Just thinking about what's going to happen on the connected TV side, this is not just a domestic story. We actually believe that this is a global story for these players. Roku, The Trade Desk, Amazon, Disney, all of these players have a global opportunity, the likes of which the linear TV players, just given the nature of the business, having to lay cables, a lot of infrastructure costs, did not have. So with that, I'll just hand it back over to Ren.
Great, thank you, Nick. All right, so we will now begin our question and answer portion of today's webinar. So a lot of great questions out there. So I'm going to start with genomics. So I know I have Ali and Simon on. This first one is for you, Ali. Could you provide some updates on CRISPR and CRISPR, the technology and some of the recent trials? And then also maybe touch on kind of the difference between Beam and CRISPR Therapeutics, so CRISPR the company.
Sure, thanks, Ren. So CRISPR Therapeutics and the CRISPR-Cas enzymes are really an exciting technological advance. We think this may just change the way we view healthcare. So we may go from managing chronic symptoms that really mask a disease to curing the disease with potential one-dose therapies. So sort of a general field clinical trial update, Bluebird Bio announced a few weeks ago that 2 patients had been treated with its sickle cell therapy. Years later, for one patient, this was about 5 years later, developed AML for one patient, acute myeloid leukemia or a blood cancer. And the second patient, MDS or myelodysplastic syndrome, which is a pre-leukemic condition. So the investigation is still pending, but I think many wonder, as well as us at ARK, what really caused this. So it could be the lentiviral vector delivery, so the delivery mechanism that they used, the preconditioning regimen, which is called busulfane, which is a highly toxic preconditioning regimen, and it's used to make room for the new stem cells. Or it could just be that sickle cell patients have an increased risk of cancer and they're on a therapy called hydroxyurea for many years, which also has a high toxicity profile. So I think once this investigation concludes, it's going to be interesting to see if we can find out what caused the cancer and how it will sort of affect the field. In terms of sort of specific trial updates for CRISPR Therapeutics, so they're kind of really on the forefront with Bluebird for one of the most advanced trials. So their clinical trials are on track. CTX001, which is their trial for sickle cell and beta thalassemia, along with their partner Vertex. They're going to complete enrollment this year. And the first patient has already completed 2 years of follow-up and will begin to now be in long-term follow-up. So that's really exciting. We haven't seen any sort of adverse events from the CRISPR Therapeutics trial, so really exciting and looking forward to seeing more data from them. We should also see CTX 110, 120, and 130 in 2021. So these are all their cancer therapy trials, so I think that should be really interesting. And then Ren, just to address your last point about sort of Beam versus CRISPR, who kind of will be the best for future prospects. So we don't really view it like that. We believe that CRISPR technologies will be more of a toolkit as opposed to just one technology. So Beam is a company that uses a technology called base editing, which basically means that you can change one DNA base, so one letter of your DNA, without creating a double DNA stranded break, which is needed for a lot of the other CRISPR enzymes or techniques. And needed for CRISPR-Cas9. So what base editing does, allows for sort of this chemical conversion of a C, G base pair into a T, A base pair. And that was actually developed in Dr. David Liu's lab. He's also a co-founder of that company. So base editing has some large positives. So it has good efficiency. You don't need to do that double-stranded break. But CRISPR-Cas9 and a lot of other the enzymes that are used for CRISPR, it's basically like molecular scissors to edit genes that have benefits. So one example is that CRISPR can be used not just to change one base to another, but it can do more complex edits, which may allow for more diseases to be targeted. So we also worry about off-target edits, which can happen with any of these modalities, or essentially unintended changes to the genome from any of the editors. But so far, as I mentioned, CTX001 for CRISPR, we have some long-term follow-up data. So far, no off-target edits that we know of. So we believe CRISPR essentially will just be more of a toolkit for important technologies that really could be used for curative therapies, and we're monitoring the space really closely.
Great, thank you, Ali. This next one is for Simon. Simon, how might semiconductor development capture and expand value for protein sequencing?
Thanks for the question, Ren. So sure. So since you asked about sequencing, I'll go ahead and mention that within the broadening proteomics space, so proteomics is the study of proteins, whereas genomics is the study of the genome. These technologies go hand in hand, of course, and have many applications across healthcare. So when it comes to protein sequencing, this is really the kind of the hallmark of a company called Quantum-Si, which is seeking to be able to actually, and Ali mentioned a few of the DNA bases, the A's and T's and G's and C's, but the alphabet for proteins is 20 different amino acids in human beings. So the sequencing component for a protein is being able to say, okay, well, what amino acids and what sequence do they exist in, and how does that create a protein? So semiconductors, if we peek under the hood of Quantum-Si's technology, there are a series of very small nanoscale wells that exist kind of patterned inside of these semiconductor chips. And the individual reactions that are happening in each of these wells, there's a flashing of light, there's a photon emission, and you have the computer algorithms that are inputting these signals and using that to understand what is making up the protein sequences. So any development in the semiconductor space is extremely important for the development of protein sequencing technology, like the ones that underlie Quantum-Si's instruments. So maybe I'll just highlight it by saying that by increasing, I mentioned those wells being embedded in the chip. The more wells that we can pack onto a chip, so think of it like the density of transistors on a semiconductor being analogous to the density of these reaction wells on a semiconductor chip. By improving that, we can increase the amount of samples that can be run on these instruments. That's called throughput. And when you throttle throughput up, you start to unlock new applications that maybe you wouldn't have been able to otherwise. So really high throughput applications, especially in the diagnostic space or in the surveillance space, you need the ability to be able to process a lot of samples. In addition to that, we think improvements could manifest on the accuracy front. So an improvement in accuracy means an improvement in speed and an improvement in your ability to not have to use complex or difficult to handle informatics algorithms on the back end. So generally speaking, I'd wrap this all up by saying that improvements in semiconductor manufacturing or the density of reaction wells on semiconductors is probably one of the main levers that proteomics companies like Quantum-Si and others can use to improve their instruments and unlock portions of the addressable market that they may not otherwise have been able to without those semiconductor improvements.
Thanks, Simon. One more for you. Could you share your thoughts on Exact Sciences and kind of its latest acquisitions?
Sure. So Exact Sciences has acquired a handful of companies as well as technologies in the past 6 months. So maybe I'll just kind of quickly give an overview of some of those acquisitions and explain how we think it will play critical roles in Exact's future. So the first one, I'll focus on Thrive Earlier Detection. This was a company that came out of Johns Hopkins that is one of the leading companies when it comes to evidence generation and technological development for multi-cancer screening liquid biopsies. So for those who don't know, this is a simple blood draw that would enable the detection of multiple cancers in earlier stages when they're the most treatable by therapy. Now, one of the reasons that we're so excited about Thrive's technology and their approach generally is an absolute laser focus on the type of evidence needed to really sway physician practice and also medical guideline alterations, as well as reimbursement from both private and public payers. So Thrive really did a great job, in our opinion, at generating the only prospective and interventional data set that really focused on the practical effects of multi-cancer screening. You know, things like overtreatment and unnecessary surgery, kind of the practical, more nuanced components of the clinical application of multi-cancer screening that we think are really important to drive massive adoption. So we think through the acquisition of Thrive, EXACT can really cement itself as one of the leaders, if not the leader, in the burgeoning multi-cancer screening space. Now, concomitant to that acquisition, EXACT acquired a smaller private company called Base Genomics. Now, Base is a really interesting company. What it does is their technology allows companies like EXACT to look at a special type of chemical modification to DNA called methylation. And what we've learned from data coming out of say Grail or some of the other companies in the space is that methylation and those changes to the outside of DNA molecules, if we capture them in blood, are one of the best ways that we can detect the earliest warning signs that cancer is beginning to manifest somewhere in the body. So you can think of it like methylation being a very important target for detecting cancer earlier. Now, the drawback with methylation is that the sample preparation process that you normally have to do for these blood samples is very corrosive and can damage methylation or even strip it off these DNA molecules, which when you're working with a sample that is already very dilute, you want to ensure that you're bringing as much of that sample to the sequencer as you can get. Now, Grail has chosen to use Twist Biosciences methylation panel for the construction of its multi-cancer test, Gallery. Whereas EXACT, by buying Base Genomics and incorporating that technology into their internal pipeline, we think that at scale, they'll have more operating leverage on the actual screening tests, because they will not be required to pay a markup to a third-party vendor on the supply chain. So we think that's an acquisition that will start to bear fruit as EXACT incorporates more methylation into all of its oncology tests, not just multi-cancer screening. And finally, I think announced on the last call and also on a press release sometime before that, EXACT mentioned that it acquired a technology called TARDIS, as well as a company called Ashion. Now, both of these things, both the TARDIS technology and the Ashion company, are actually from the Translational Genomics Research Institute, or TGen, which is a clinical research subsidiary of the City of Hope Health System based in California, and which has a presence in the southwestern United States. This technology is mostly used for a type of diagnostic test called MRD detection, or minimal residual disease detection, which is also a type of liquid biopsy, but instead of detecting cancer before a diagnosis, so screening, this technology would be used to assess how a cancer is responding to treatment, right? Looking for minimal residual disease or traces of cancer cells that we were not able to eradicate through therapy. So there's a lot of crosstalk between everything that I just mentioned. So we think that by incorporating it all together, EXACT can begin to broaden out their oncology portfolio. And we think that generally speaking in the space, a broader diagnostic menu is a key facet that will determine market share ultimately amongst all of these molecular diagnostics companies.
Great, thank you, Simon, for that. We are going to shift over to our autonomous technologies and robotics team. So Sam and Tasha are on. This first question actually is for both of you. So as more and more companies enter the EV and autonomous race, why is Tesla still in the lead? And I'll also highlight that there's a number of questions around our Tesla valuation. So I'll note that we will be releasing an updated blog in about 2 weeks on that. But with that, I'll let the team answer that question.
Sure. So I'll start off with EVs and then pass it over to Tasha to talk about autonomous technology. On the EV side, there are a few things. And one of the things that we look at is the range and efficiency of the vehicles balanced with the performance of the vehicle. And when we're looking at that, it's very clear that Tesla is at least 3 years ahead of the competition. And you can see that just by looking at the announcements from other car companies when they come out. And you can see the battery size, the range that they expect, the acceleration of the vehicle, as well as the charging speed. And so those are some very easy to measure metrics where you can tell that Tesla is ahead. Some things that are harder to measure, but still keep Tesla ahead, really emerged at Battery Day and its plans to ramp up cell manufacturing itself and really try and take more of the future into its own hands, where it can continue to execute and innovate at Tesla's rate of innovation, as opposed to waiting on suppliers and the industry to catch up. And that's been Tesla's MO for the past decade and what's kept them ahead this whole time. And then I'll pass it over to Tasha to talk autonomous.
Sure. Well, first I'd say that Tesla, one of the reasons we're so interested in their autonomous strategy, and we think they could be a leader in the space, as we said before, is that the approach that they're taking to solving for full autonomy is unique. They're using their fleet of customer cars that they can basically have as an optional data library to pull from in order to train the car on certain corner cases. Most recently, this past weekend, we got an exciting update, which was that the full self-driving beta version of the new Autopilot update will be available to, it sounds like, all Tesla owners in a matter of time, whereas previously this was limited to a select group of expert drivers. I think that opening up this beta is a good sign in how confident the company is in the technology. To toggle back to their strategy, I think that this is something that's very unique to Tesla, and that other than some of the newer players in Asia, which have smaller fleets, Tesla is right now, the only company with over 1 million cars on the road that it can pull from to train its autonomous algorithms. We have seen some startups already commercialize their efforts. So in China, AutoX was the first to launch a truly commercial robotaxi platform. In the US, that was Waymo. So Tesla could be second. And to be clear, it's not 100% certain that they will do this, right? It's still unsolved for. But the advantage that we see is really in that data effort. So when we talk about Tesla being ahead of others, we're talking about that data advantage. And then I'll quickly touch on the valuation update. This is something that we as a team have been working very hard to put out to you all. We're really excited to share this with you. It should be out within the next couple of weeks. So please look out for that and look forward to it.
Thanks, Tasha. So going back to Sam, is there any future for solar? Can you share our thoughts there?
Yep. And here there are a few distinctions I would make when we talk about solar. The technology, whether it's utility scale or residential. And then again, going back to that, separating the technology from whether values accruing to companies. So we definitely think that there is a future for solar, the technology. And then on the economics of it, utility scale solar is far more economic than residential scale solar. And then when we go to the residential side of the market, we think that there's a lot more value that can accrue to building integrated photovoltaics. So something like a solar roof, or potentially in the future, some type of solar window application relative to rooftop solar where you're attaching panels onto the roof. And so we've done research there where even though solar panels are coming down in cost, the balance of system costs, the cost of customer acquisition, of getting someone up on your roof to actually install the rooftop solar makes the economics less than desirable in many places, the majority of the United States. And those other costs don't come down the same way that technology costs come down. So the customer acquisition costs, the putting a person up on your roof costs, are harder to bring down. Whereas when you go over to a building integrated photovoltaic solution like a solar roof, then there's far more technology involved. And that actually can help bring down those other costs because you already are having someone build a roof. So you already have people up there and working. You could also potentially partner with home builders where the customer acquisition cost comes down from that angle as well. So that's kind of the different frameworks we're looking at for the future of solar.
Thanks, Sam. Okay, one last question, and this one is for you, Tasha. We got a number of questions around drones. Could you maybe just update everyone on some of our research there and updated projections, and what do we look for when we're looking at drone companies and kind of the use cases there?
Sure. Drones are something that Sam and I cover together. I cover the, the smaller sort of logistics drones, while he covers the eVTOLs, the electric vertical takeoff and landing craft, which are the future of air taxis. So the updates to that research, well, first I'd say, big ideas is the best place to look for the all of our updated estimates there. In the space that I cover, the logistics and the parcel delivery drones and the food delivery drones, we think both of those markets could amount to over $100 billion in delivery revenue opportunity by 2030. For updates, I would say that the most interesting thing that's been happening in this space are, one, Cathie mentioned many companies that are going public. The drone space has been very active for new companies looking to go public, which is exciting and provides us opportunities. For the regulation of these drones, as opposed to autonomous vehicles that are, or passenger cars on the road, which actually had much more friendly regulation in the US compared to in other countries. The drone space had been somewhat limited by restrictions that the FAA had placed on flights. And in many ways, this makes sense. Something is flying above your head. There's a little bit more safety concern there as opposed to rolling on the ground. But the exciting thing is that the FAA has signaled in many ways that it is looking to move faster on regulation. That is through giving companies approvals to provide services and act as drone airlines, as well as certain beyond line of sight operations, which is really important, especially in the case of autonomous technology, because the beyond line of sight is what unlocks the cost advantages that we see for drones in this space. So, and then on the infrastructure side for eVTOLs, Sam's space, we saw plans to create one of the first vertiports in Florida here in the US. And again, we're just seeing a lot more sort of contracts and government approvals happen in that space, I'd say, than ever before. So that's sort of what we're most excited about. The US seems to be finally moving a little bit faster than they had previously. And a lot of the innovation that was happening at US companies, which were testing abroad their technology because they couldn't test here, we think now there's the opportunity to use that innovation closer to home, which is pretty exciting for us.
And then Sam, do you have anything else to add on that?
I would just echo and provide additional commentary. What Tasha's saying for those small factor drones and the way that the FAA is moving really has transformed. And I think the US recognizes that this is a competition for innovation and jobs and really pushing the boundary forward. And we saw that with those small scale drones as DJI in China really outpaced the US in innovation. And I think that really got a hold of the FAA, that really drew their attention. And so they're trying to make sure that doesn't happen for the air taxi space as well. And so they really want to be the leader in that space. And I think that would be really great for innovation in that area.
Excellent. Thank you, Sam and Tasha. So I have just one last question for the analyst. This one is for Nick. So coming back to you, Nick, could you share your thoughts on Draftkings and its future?
Yeah, absolutely, Ren. This is a great question. And maybe just taking a step back first and talking about how we view the online gambling space. Just to put it simply, we think that there's a significant supply and demand issue in online gambling because of the way the regulatory hurdles have shaped up. You have a ton of demand out there for online gambling services, but not a ton of supply because it's illegal in most states. But that is changing. Consumers want more and more to be able to interact with their, whatever live sport is their favorite. And we believe that online gambling offers that just a more interactive experience. And so you take those factors into consideration. And when we looked at Draftkings, what we really saw that excited us here was the tech stack, in that they are trying to vertically integrate through all of the services that are needed to build out an online gambling service. And what this allows is a competitive advantage given the nature of the space and how in each instance, when a new state decides to open up to online gambling, you need to be ready to launch faster than your competitors, so to speak, kind of getting a leg up. And we believe that the tech stack that Draftkings has allows them to be in that first cohort. But then in addition to that, we believe that the partnership deals that they've struck throughout the different leagues gives them an advantage in terms of being able to market themselves as one of the go-to premier services in online sports betting, and then also further down the line in iGaming. And just to kind of summarize how big of an opportunity this is, and I'll just use the company's own numbers here. They actually put them out this morning saying that in a mature state for the US, the total market size for online gambling, and this is inclusive of both iGaming and online sports betting, is roughly $60 billion. And where we're at today in terms of revenues, if you look at 2020, and this is despite a horrific year for online or for sports, the market was around $1.8 billion. So massive opportunity, and our own internal numbers align very much so with their $60 billion estimate. We modeled this out to 2025 and assumed roughly 30 to 34 states would have either partial or full legalization, and got to around $37 billion in total market size. And this is inclusive of online sports betting, which we believe is going to grow from 1.8 billion to almost $18 billion in revenue in that 5-year time frame, and then also iGaming as well as esports. So we're really excited about the space and what it offers these leagues, and we think Draftkings can help push this narrative forward.
Thanks, Nick. Okay, we have time for just one last question, so I'm going to turn it back to you, Cathie, and if you have any just closing remarks. But one of the questions we got here is most investment managers are very closed off when it comes to their research and investments. Why is ARK so open and transparent in terms of trading and research?
Right. So a couple of reasons. One of the reasons we push our research out, not when it's finished, but as it's evolving, is we want to engage with the communities that are doing the innovating. We actually want to become a part of those communities as much as possible. And because what we're doing, we're sizing markets for them and figuring out the unit economics, talking about barriers to entry, new technologies and so forth. We're coming at the world from a different angle than they are. Many innovators are heads down, moving forward as quickly as possible. And so, they have a lot more detail about the various technologies. We're framing the opportunity, the more knowledge we have. And it's a win-win. The first sharing economy company in the asset management space when it comes to research. If you don't give, you don't get. There's no dialogue. It's been a win-win, I think, for us to open up. You know, we always say truth wins out. It's amazing the volatility around certain names. We just keep our eye on the prize, and with each prize is a price target we have. So we're pretty disciplined in that way as well. And you know, there's a tremendous amount of opportunity out there in the world of innovation, like never before. So we're happy to share our thoughts and look forward to taking more questions on the next webinar.
Thank you, Cathie. And that will conclude our webinar. Thank you everyone who joined today's call, and thank you to the ARK team. A replay of this webinar will be posted to ark-invest.com by the end of this week. So thanks again, and enjoy the rest of your day.